Welcome to the Riskwiser Zone, the show where we dive into the world of stocks and finance to help you make informed decisions about your investments. We're starting off with a story that's been making waves in the energy market. Crude oil prices are sharply higher as the war in Iran disrupts global supplies. The conflict has entered its fourth day with no signs of de-escalation, and the closure of the Strait of Hormuz has forced Iraq to shut down oil production at its largest fields. This strategic waterway handles a significant portion of the world's oil, so any disruption can have far-reaching consequences. The situation is complex, with multiple factors at play. On one hand, we have Iran's threats to set fire to any ship attempting to pass through the strait, which has raised concerns about the safety of oil tankers and the potential for further supply disruptions. On the other hand, we have reports of increased crude exports from Venezuela, which could help offset some of the losses. The International Energy Agency has cut its estimate of the global crude surplus, but there are still concerns about mounting crude supplies in floating storage. And, to make matters more complicated, Russia's ongoing conflict with Ukraine is also affecting global oil supplies, with Ukrainian drone and missile attacks targeting Russian refineries. So, what does this mean for investors? Well, it's a mixed bag. On one hand, higher oil prices can be beneficial for energy stocks, but on the other hand, they can also lead to higher production costs and decreased demand. As always, it's essential to stay informed and adapt to changing market conditions. We'll continue to monitor this situation and bring you updates as more information becomes available. In the meantime, we want to hear from you. How do you think the conflict in Iran will affect your investments? Share your thoughts with us on social media using the hashtag #Riskwiserzone. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're exploring the world of risk and finance, and today we have a fascinating story that combines industry trends, market analysis, and investment insights. Our middle segment takes us into the realm of steel production and the global market dynamics that are shaping this sector. We've been following the news about Nippon Steel's acquisition of U.S. Steel and how this move is impacting the global steel industry. To dive deeper, we looked at the VanEck Vectors Steel ETF, which tracks a basket of companies involved in steel production, fabrication, and iron ore mining. This ETF has been a potent performer, with its top holdings including Nippon Steel among 39 other stocks. The narrative for the steel sector is currently dominated by a structural shift toward infrastructure-led demand and the transition to green steel production. On one hand, we have a bull case that's anchored by a significant rebound in global demand, expected to grow modestly by about 1%, 3% in 2026. This growth is fueled by massive infrastructure projects in the US and India, alongside a stabilization of manufacturing activity in Europe. On the other hand, the bear case centers on the persistent weakness in the Chinese real estate sector and the resulting volatility in raw material prices. China remains the world's largest steel producer and consumer, and its ongoing housing downturn continues to weigh on global iron ore sentiment. While Chinese production is expected to decline by roughly 4.5% in 2026 due to tighter environmental controls, the risk of excess Chinese steel being dumped on global markets remains a primary concern for Western producers. From a technical analysis perspective, the SLX chart shows a stretched ETF price trend that seems priced for a decline. The percentage price oscillator just crossed over from a very high level, indicating potential caution. However, using the ROAR score analysis, we see that this ETF still has a score of 50, not indicating extreme risk. What does this mean for investors and traders? While it's not a move to chase, SLX has set new high ground, which could potentially lead to another monster move higher after a pullback and consolidation period. As always, patience is required. but this story highlights the importance of staying informed about industry trends and market analysis to make informed investment decisions. Welcome back to the Riskwiser Zone, where we cut through the noise and bring you the most insightful analysis of the market trends. As we navigate these uncertain times, it's essential to stay informed and level-headed. Today, we're going to discuss the potential implications of the ongoing conflict in Iran on the U.S. economy and inflation expectations. Joining me are two fascinating guests, Steve Moore, co-founder of Unleash Prosperity and former Trump economic advisor, and Alli McCartney, managing director of wealth management with Alignment Partners at UBS. They'll share their expertise on how the current situation might impact the markets and what investors can expect in the coming days. Steve, let's start with you. You've been a strong advocate for President Trump's economic policies. How do you think the administration will respond to the rising inflation concerns amid the Iran conflict? Will we see any significant changes in their economic strategy? As Steve Moore notes, it's too soon to tell about inflation or rate path expectations due to questions about the duration of the Iran conflict. This uncertainty is reflected in the comments made by Minneapolis Fed President Neel Kashkari. It's a reminder that, in times of geopolitical turmoil, it's crucial to remain vigilant and adapt to changing circumstances. Alli McCartney from UBS brings a wealth of knowledge on wealth management. Alli, can you walk us through the potential risks and opportunities for investors in this environment? How can they navigate the complexities of the market and make informed decisions? As we've seen in the past, markets often react impulsively to news, but it's essential to take a step back and assess the situation calmly. The concept of a Trump put, the idea that President Trump will find a way to contain the fallout from any crisis, is being questioned by Wall Street strategists. They warn against relying on this notion, especially when it comes to the Iran war. In times like these, it's vital to remember that markets are inherently unpredictable, and even the most experienced analysts can't foresee every possible outcome. As the first always say, don't panic. It's crucial to stay level-headed, focus on the long-term perspective, and avoid making impulsive decisions based on short-term market fluctuations. As we conclude today's episode of the Riskwiser Zone, I want to leave you with a thought-provoking question. Where do you stay your money Monday? In these uncertain times, it's more important than ever to have a well-thought-out investment strategy and to remain adaptable. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.